Okay, let's talk about a huge change coming to the United Kingdom's tax system. Starting April 6, 2025, the entire foundation for how the UK figures out tax for international individuals is being completely reset. Now, this isn't some minor tweak, it's a total overhaul of who pays UK tax and how they pay it. For over 200 years, UK tax has revolved around this idea of domicile. Think of it as more than just where you live. It's about where your permanent, long-term home is, often a connection that's inherited. Well, as of 2025, that's all going away. It's being totally replaced by a much, much simpler question. Are you a UK tax resident or not? So let's be clear, this is a massive shift. It's going to affect anyone who's thinking about moving to the UK or who already lives there but has financial ties to other countries. The old rulebook is being thrown out and a brand new one is taking its place. At its heart, what we're seeing is a move from a really complex, historical idea to something that's just simpler and more objective. Under the old system, if you were considered non-domiciled, you could use something called the remittance basis. That basically meant you only paid UK tax on foreign money you actually brought into the country. The new system? Much more straightforward. Pretty much everyone will be taxed on the arising basis, which means your worldwide income is taxable in the UK. But, and this is a really big but, there's a major new carrot being offered to people who are new to the UK. And that major new incentive is really the centerpiece of this whole new system. It's called the Foreign Income and Gains Regime, or FIG regime for short. You can think of it as the government's way of making sure the UK stays competitive on the global stage. The main idea here is pretty simple. Attract talent and investment by making the first few years of living in the UK very, very tax efficient. It gets rid of all the complexity of the old non-dom rules and replaces it with a clear, time-limited benefit. And here's the headline benefit: 4 years. For your first 4 years of UK tax residence, you can choose to pay zero UK tax on all of your foreign income and gains. And just as important, you can bring that money into the UK during those 4 years without any tax charge. But there is a really important requirement to get in the door. To even be eligible for this 4-year window, you have to have been a non-UK tax resident for at least 10 consecutive years right before you move to the UK. It's a very clear line in the sand. So the process itself is designed to be very logical. You meet that 10-year condition, you move and become a UK resident, you make a claim for the relief, and then you get to enjoy that 4-year tax break. It's a very structured path for anyone arriving in the UK. So what happens when those 4 years are up? Well, the incentive period ends. It's as simple as that. You just transition smoothly onto the standard UK tax system, which, as we said, is the arising basis. From that point on, you're taxed on your worldwide income and gains, just like any other long-term UK resident. Now, all of this really hinges on one single critical question. With the whole idea of domicile gone, how exactly does the UK now figure out if you're a tax resident or not? Well, the answer comes down to one specific test. It's called the Statutory Residence Test, or the SRT. And frankly, this is now the only game in town. It's a very detailed, objective set of rules that looks at things like how many days you spend in the UK and what your personal connections are, all to give a clear yes or no answer on your resident status for a specific tax year. The SRT works kind of like a logical funnel. First, it checks if you meet any of the automatic overseas tests. If you don't, it then checks the automatic UK tests. And if your status still isn't clear, it comes down to the sufficient ties test, which basically weighs your connections to the UK, like family, work, or property, against the number of days you spend here. Okay, so that covers new arrivals. But what about people who were already in the UK living under the old non-dom system? Well, the new rules include some very specific arrangements to help manage that transition. One of the biggest measures here is a Temporary Repatriation Facility, or TRF. It's basically a special, limited time window for people who have untaxed foreign income and gains that built up before the new rules start. It lets them bring those funds into the UK at a very attractive tax rate. And the rate is the really key detail here. For just 2 tax years from 2025 to 2027, eligible people can bring these historical funds to the UK and pay a flat tax rate of just 12%. That's a really powerful incentive to move offshore capital into the UK economy. But this incentive is strictly time-limited. After this 2-year window closes, any of that pre-2025 foreign income that you bring into the UK will be hit with a standard and much higher income tax rates. That 12% rate is very much a use it or lose it kind of deal. Of course, UK domestic tax law doesn't exist in a vacuum. It has to work together with this whole web of international tax treaties and special agreements for certain people, which adds another interesting layer to the whole picture. A really crucial part of this international framework are things called double taxation agreements, like this one between the UK and Israel. Their main job is to figure out which country gets the right to tax certain income, all to stop you from being taxed on the very same money twice. But this brings up a really common problem. What happens if, under the local laws in both countries, you actually qualify as a tax resident in both places at the same time? Well, this is exactly where these treaties provide a clear solution. The treaty has what's called a tiebreaker test. It's a very strict sequential process. You don't just pick the one you like, you have to go down the list one by one. The very first test that points clearly to one country over the other settles the debate. For tax purposes, you'll be considered a resident of only that one country. Problem solved.
And finally, there's a really important exception for people who work for certain international organizations, like the European Bank for Reconstruction and Development or the UN. Their salary is subject to an internal tax by the organization itself, so it's exempt from UK income tax, no matter what their residency status is. But, and this is the critical point, that exemption is very specific. For all of their other personal finances, like investments, capital gains, or even their spouse's income, the UK's SRT and the new FIG regime apply completely.
So we've seen this complete pivot away from a complex 200-year-old system based on domicile to a new modern framework that's all based on one simple question: are you a resident? The new 4-year tax-free period is clearly designed to be a powerful draw for global talent. The ultimate question, really, is whether this simplified system will make the UK a more competitive place for global citizens in the long run, or just a different kind of place.